Mrs. Zainab Subsidy Ahmed. Shall we all rise? Dr. Mrs. Zainab Subsidy. Once again, please welcome for a welcome remark. Please a round of applause.
i.e. both physically and virtually, so that as many people as desire to participate will be able to do so. Apart from being a requirement of the Fiscal Responsibility Act 2007, this event and our approach to it reflect our commitment to transparency and accountability in public financial management, PFM. The recently released Open Budget Index report by the International Budget Partnership, IBP, bears eloquent testimony to the progress the federal government of Nigeria has made in improving transparency and accountability in PFM. Nigeria posted its best performance in the Open Budget Survey, improving by 24 points for transparency in the latest OBI report. The total transparency score for Nigeria of 45 in the 2021 survey is a significant leap from the 21 scored in 2019 and even lower scores in prior periods. And this performance is the second highest improvement worldwide in the 2021 survey. As you will hear shortly when the Honorable Minister of Finance, Budget and National Planning makes her presentation, our country is going through significant fiscal challenges. And so this forum is really what it is called, a consultative forum. It is our hope, it's our expectation that when the time comes, you will engage in providing solutions, suggestions about what we could do or what we could do better or what we could do more in addressing these challenges, rather than, as you will see, the challenges are well understood and well articulated. But of course, if you really think that we have misdiagnosed the problem, we will be quite happy also to hear your own perspective to this. But the point that I'm making is, let this not be a session of simply recounting, or wailing over the challenges, but one that is intended to improve our own thinking in terms of how to address these well-known challenges. And therefore, without further ado, it is once again my pleasure to welcome you all to this event, and we look forward to a very rewarding time here, a very interactive session. We also need to be time efficient, especially given that we have a significant online audience, and therefore we may not be able to stay online for too long. So please bear with us. We'll try and be very efficient in time management. Thank you, and God bless the Federal Republic of Nigeria.
Should look like. This is a consultative session. We have scheduled a series of consultations. We'll also be consulting with the governors. We'll be consulting with leadership from the National Assembly. So this is an input-taking session. and everything that is here is a draft. So we really do look forward to receiving valuable inputs from members of the public today. My presentation has an outline, and I'll try to do this as efficient as possible to give more time for discussions. There will be an overview. In addition to an introduction, there will be an overview of our 2022 fiscal outcomes, how we have performed so far, so just reporting, and then an update on the performance of the 2022 budget. Then we will present the key assumptions and macroeconomic framework that we're proposing for 2023 to 2025, and then we'll show you an overview of that framework following the assumptions that we made, and then we'll close out on the meeting. So, ladies and gentlemen, this draft 2023 to 2025 MTEF has been prepared against a backdrop of the continuing global and domestic challenges in the aftermath of the COVID-19 pandemic. Factors that impact the medium-term fiscal outlook include the Russia-Ukraine war, which has assumed a new and very worrisome dimension with severe implications on food and energy prices globally, the resurgence of COVID-19 pandemic in some major economies, which has led to a slowdown of activities in those economies, the renewed and elevated inflation in most countries prompting monetary tightening in these economies with the inherent negative impact on capital inflow to emerging economies like Nigeria. Also, of course, we have the challenges of domestic macro and business environment and the negative impact of security on our domestic economy. The Nigerian economy sustained its recovery from recession for the fifth consecutive quarter, growing from 3.11% in real terms in the first quarter of 2022. Most sectors recorded positive growth. The broad-based growth reflects the effective implementation of the economic sustainability measures undertaken by the Buhari administration. Like many other economies, our economy faces lingering COVID-19 pandemic effects, as well as higher global food and fuel prices due to the Ukraine-Russia war. The IMF projects global growth to slow down from an estimated 6.1% in 2021 to 3.6% in 2022 and 2023. Nigeria continues to be exposed to risk aversion in the global capital market, which will put further pressures on the foreign exchange market as foreign portfolio investors are yet to return to the Nigerian market. The Central Bank of Nigeria expects the renewed pressure on the foreign exchange market and accompanying naira depreciation to subside from the third quarter of this year. An overview of the 2022 fiscal outcomes and an update on the 2022 Federation revenue performance. So the performance of the 2022 budget parameters, including oil production, which was set at 1.6 million barrels per day in the amended budget, if you recall. The actual performance, and this is as at April 2022, is 1.32 million barrels per day. We understand that there is an uptick to 1.4 million barrels per day as at May, but my report is as at April. The oil price, on the other hand, which was fixed in the budget at $73 per barrel, is an average of 103.6 dollars per barrel. So that is an improvement over what we projected. But note that the production is very low. The exchange rate, on the other hand, that was fixed at 410 naira 15 kobo, is now 415.1 naira to the US dollar. Inflation, which we had projected initially at 13%, and we have had to revise it upwards to 16.11% in the amended budget, is now up to 17.71% and has gone higher also in the last month inflation that was released last week to 18.4%. GDP growth, which we had forecasted in the adjusted forecast of 3.55%, is now at an average of 3.11%, and again, this is as at April. The performance of the budget parameters indicates that the actual crude oil price is higher than the budget benchmark of $73 per barrel. However, high oil prices are offset by the lower output, which as at April stands at 1.32 million barrels per day. NNPC attributes the fall in oil production to the high incidence of crude theft and pipeline vandalization. Exchange rate and inflation and GDP growth varied variously according to the vis-a-vis the targets as presented in the previous slide. Growth is, however, expected to accelerate given efforts to contain structural issues impacting adversely on the cost of doing business. An overview of the oil revenue performance for 2022, and again, this is up to April. The gross oil and gas federation revenues for full year 2022 was projected at 9.37 trillion naira for the whole year 2022. But as at April, only 1.23 trillion was realized out of the prorated portion of 3.12 trillion as at April 2022, representing a mere 39% of the performance against the target. Despite higher oil prices, oil revenue underperformed due significantly to oil production shortfalls for two main reasons. One, oil production shut-ins resulting from pipeline vandalization and crude oil theft, and two, high petroleum subsidy cost due to higher landing costs of imported products into Nigeria. Non-oil taxes trailed targets marginally with a performance of 92.6%. This means that the revenue that has accrued so far is largely from non-oil sources. Revenue performance is expected to improve in the second half of 2022 as a result of concerted efforts to address oil theft and pipeline vandalization. There's also the seasonality of some of the non-oil taxes, which means that we expect to collect significantly more in the second half of the year. For example, company income tax payments normally fall due from the third quarter of any particular year. So we expect more of the non-oil taxes to accrue in the second half of the year. This improved revenue collection should also moderate the debt service to revenue ratio, which is currently above our target levels. So the table at slide 11 shows the summary that I have just indicated, and because I'm having difficulty seeing the figures, I will just leave it for you to see it when we post it on the website. The overview of the Federation fiscal outcomes also includes the federal and VAT pool accounts distributable. So the amount available for distribution from the main pool of the Federation account from the VAT source is 1.52 trillion. Of this amount, the federal government received 802.5 billion, while the states and the local governments received 407.04 billion and 313.81 billion respectively. The federal, state, and local governments received 107.67 billion, 358.90 billion, and 251.23 billion respectively from the VAT pool. Again, the table under this is just putting the numbers as I have just summarized. Let me move now to an update on the 2022 federal government budget as at January to April. As at April 2022, federal government's retained revenue was only 1.63 trillion. That is 49% of the prorated target of 3.32 trillion. The federal share of oil reserves, of oil revenue, I beg your pardon, was 285.38 billion, representing 39% performance, while non-oil taxes revenue totaling 632.56 billion represents a performance of 84%. With CIT and VAT collections posting 298.83 billion and 102.97 billion, representing 99% and 98% respectively. Customs collection made up of import duties, excise and fees, as well as Federation account special levies, trailed target by 76.77%, which is equivalent to 25.42%. Other revenues amounting to 66.64 billion, of which independent revenue is 394.09 billion, is also below target. The aggregate expenditure for the 2022 budget was 17.32 billion. That's the size of the 2022 budget, with a prorated spending of 5.77 trillion, 4 months, January to April 2022. The actual spending as at 31st of April 2022 was 4.72 trillion. Of this amount, 1.94 trillion was for debt service, 1.26 trillion was for personnel costs, including pensions, and as at April, 773.63 billion has been spent on capital expenditure. The total performance of the capital of the aggregate expenditure is almost 80%. So let's move now to the key assumptions and the macro framework for the 2023 to 2025 medium-term fiscal framework. The key parameters, as well as other macroeconomic projections driving the medium-term revenue and expenditure framework, have been revised in line with emerging realities. The new figures are represented in this table that is on the screen. But let me just post a note to say that the initial projection looks like it's not likely to be achieved based on current trends. The medium-term projections also that we present here deviate from the National Development Plan of 2021 to 2025 for the same 3 years. This we have had to update based on a combination of current realities and a modified medium-term outlook. For instance, inflation and growth in the National Development Plan are projected at 14.93% and 4.39%, and you will see that this has been adjusted in this outlook. So the oil price benchmark for 2023 is projected to be $70 per barrel and $66.62 for the outer years of 2024 and 2025. Oil production is projected to be 1.69 million barrels per day, and we expect an uptick in 2024 to 2025 of 1.83 to 1.83 million barrels per day. Exchange rate is expected to go up, with the naira depreciating marginally from 410 naira 15 kobo to 435 naira and 57 kobo for the 3-year reporting period. Inflation, on the other hand, is projected to be 17.16% average for 2023, 16.21% for 2024, and 17.21% for 2025. The non-oil GDP is projected to be 214 trillion, up from 188 trillion, while in the outer years it's expected to move up to 239 trillion and 269 trillion respectively. The GDP growth is projected to be 3.75%, up from 3.55% of 2022. This is in 2023, 3.75%, and we project a dip in 2024 to 3.3%, and then a slight uptick in 2025 to 3.46%. The nominal consumption, on the other hand, is remaining almost relatively flat from 120 trillion in 2022 to 121 in 2023, and then to 123 in 2024 and 125 in 2025. So the key assumptions that we made, just the basis for the medium-term projections, I've said earlier on, deviate from the National Development Plan, and this we had to do to bring the projections on the national development to current realities. In the MTEF, real GDP growth is projected to be 3.75% in 2023, and it will go up to 3.30%, go down to 3.30% in 2024. The inflation rate is projected to be 17.16% year-end average for 2023, and it will go up to 16.1% in, that is, having gone up from an average of 16.11% for 2022. The upward pressure on prices is expected to be driven from the current lag effect of the global price surge due to the Russia-Ukraine war, and also due to the domestic insecurity, due to the rising cost of imports, and also exchange rate depreciation, as well as other supply side effects. Growth in nominal GDP consumption has been adjusted in line also with current realities. The revised estimates are based on the components of the GDP as reported currently, and also on historical figures. The medium-term nominal consumption is projected to be 121.93% for 2023. Investment, especially from foreign sources, is expected to be dragged down by interest rate hikes in advanced economies, foreign exchange management concerns in Nigeria, and other domestic challenges, including insecurity. An overview of the 2023 to 2025 medium-term revenue framework. For oil and gas revenue and federally funded upstream projects for the reporting period, the projected fiscal outcomes in the medium term are presented under two scenarios, and we need inputs from this consultative forum on these two scenarios. So scenario one is a business as usual. This is assuming that the subsidy on PMS, which is estimated to be 6.7 trillion full year 2023, will remain and will be provided for. That is scenario one. That is, we don't remove fuel subsidy at all from January to December next year. Scenario two, on the other hand, is a scenario that we are calling reform scenario. This assumes that petroleum subsidy will remain up to mid-year 2023, that is June, and this is meeting in line with the commitment that we made when we made an adjustment to the current year budget to say that the first subsidy provision will be extended to 18 months, and this 18 months will be up to June of next year. In which case, only 3.36 trillion will be provided for in the 2023 medium-term framework. Additionally, there will be a tighter enforcement of performance management framework for government-owned enterprises that will significantly increase operating surplus and dividends remittances in 2023. And also the assumption is that in 2024 and 2025 that there will be no fuel subsidy expenditure for the Federation. So both scenarios have implications for net accretion of revenues to the Federation, as well as for the fiscal deficit that we report. And the table below, which I hope you will take time to look at physically, shows the impact of this. For example, total oil revenues for 2022 is 9.369 trillion. And for 2023, because of the reduced price that we assumed of $70 per barrel, it will go slightly down to 8.57 trillion in 2023. The deductions, that is the expenditure that the Federation bears, for 2022 is 4.15 trillion. And these deductions are, as listed below, include National Domestic Gas Development Project, Infrastructure Project, Frontier Exploration Project, Renewable Energy Development, Pipelines Project, PMS under recovery, as well as refinery rehabilitation, and some gas pipeline. This is 2022. But recall that just 2 days ago that the President unveiled the new NNPC. And by the unveiling of the new NNPC, it means all of this upstream investments will be undertaken by the NNPC, the new NNPC Limited. But the Federation is expected to continue to bear the burden of fuel subsidy, even in the new arrangement. So the fuel subsidy cost to the Federation will be 6.715 trillion in scenario 1. That is the scenario that says that we will maintain fuel subsidy throughout 2023. In scenario 2, this is down by half, because we are assuming down by half to 3.357 trillion, because we are assuming that the subsidy will be ending as of June 2023. So the implication you can see for the net revenues is, if we keep the fuel subsidy throughout 2022, compared to 4.57 trillion net revenues in 2022, in 2023, if we keep the subsidy, the net revenue will be 500 million. That is the implication. Moving from 4.539 trillion to 500 million. On the other hand, if we are able to end the subsidy by June of 2023, the revenue that will accrue to the Federation, and when I say Federation, it's federal government and states, will be 3.857 trillion. So that is the import of fuel subsidy. And then if you look at the outer year of 2024, where we assume no fuel subsidies at all, the revenue will now go up to 7.679 trillion with the same $70 per barrel crude. So ladies and gentlemen, your input is required in this regard. Let me just then very quickly move on to, so the scenarios I've already described, and the expenditures that we expect in the medium-term framework are also shown on the tables. So vis-a-vis the budgets, the total revenues that we just projected, we're expecting that the federal government total expenditure, excluding government-owned enterprises, will be 15.3 trillion for 2023 under scenario 1, and 16.308 trillion under scenario 2. When you aggregate government-owned enterprises budget, this will move to 16.982 trillion and 17.989 trillion respectively. So, Honorable Minister, Permanent Secretaries, DGs, ladies and gentlemen, this is the 2023 to 2025 medium-term expenditure framework and fiscal strategy paper for public consultation. We look forward to your inputs. Thank you very much.
A round of applause for the Honorable Minister, Dr. Mrs. Zainab Ahmed.
Basi Udo, Mr. Imam from Vanguard, Benjamin, and also from the online participants for your questions. Let me just say that the arrangement has indicated that NMPC will not be contributing monthly to the Federation as they used to in the past. But NMPC will be paying royalties, dividends, and taxes. So while the revenue might not be monthly, we will work out an arrangement with NMPC on how this will be paid. And it is possible to work out an arrangement where the payments could be monthly or quarterly for this same. It's not working. It's not working. Sorry. Okay, let me use this. Can we move it? Can you hear me now? Okay, sorry. So I was just saying that the new arrangement requires that NMPC will not be contributing to FAC on a monthly basis. But NMPC will still be paying taxes, royalties, and dividends. And we will be engaging the NMPC on how we expect these inflows to come to the Federation. So we can negotiate that these remittances are done on a quarterly basis, for example. But let me also say that prior to the NMPC transiting, for, yes, about 8 months, we have not been receiving any revenues from NMPC, and we have been coping as a federation. Why have we not been receiving any revenues from the Federation? Because NMPC has been instructed to cover the cost of fuel subsidy on behalf of the Federation. So NNPC is not paying the subsidy on its account, is on account of the Federation. So assuming they were not paying that subsidy value will have been remitted to the Federation. And this is the arrangement that we seek to continue in 2023. So it will still be a Federation expenditure, but it will be undertaken by NNPC as a supplier of last resort. And we see a situation where maybe with the coming on stream of new refineries, that other marketers will begin to find the PMS retail market attractive enough to invest in buying fuel themselves and selling to the Nigerian market. And that's why it's important for us to consider this issue of removal of fuel subsidy very, very seriously. Because no marketer is willing to buy PMS after sourcing their foreign exchange and come and sell it at control price. It can only be a government agency, and in this case, NNPC, on the instruction of the Federation. Mr. Ma from Vanguard was asking what is the difference between the actual revenue and, actual expenditure to the actual revenue. So the difference is 3.09 trillion, and that means it's a deficit that we have had to finance by borrowing. That's the difference. And why are we having this difference? Because we're carrying a huge subsidy cost. That's why we're having this kind of gap. And also, you asked whether NNPC will fund because NNPC will now fund its upstream investments, that whether the funding of fuel subsidy will also be funded by, and I explained that NNPC has been funding fuel subsidy, but they're doing it on behalf of the Federation, so it's on the cost of the Federation. Even though they are the ones undertaking it, we are paying them for it. So when they generate revenue, instead of remitting the revenue, they're using part of the revenue or all of the revenue to fund fuel subsidy. That has been the arrangement, and that is what will continue to be in place until we exit the fuel subsidy as a nation. Benjamin from Blueprint also asked whether the 2023 scenario, whether the states are paying, why as a citizen you go to a state or even in the outskirts of Abuja and pay higher farm price when in Abuja and Lagos you're paying control price. Again, that is the economics of fuel subsidy. In reality, majority of Nigerians are not actually paying that official farm price. So it's the economics of fuel subsidy, and as a nation, we have to consider what makes sense for the majority of the people. And it doesn't lie with, the decision doesn't lie with the Ministry of Finance alone. On the questions from the online audience are all about why don't we remove this fuel subsidy? That's what I hear from the three questions that the moderator read online. Why don't we remove this fuel subsidy? The answer lies with Nigerians.